Silver didn't move. That's the signal. While you were watching price, the structure underneath shifted. JPMorgan quietly crossed 750 million ounces tied to COMEX channels. China just restricted silver exports. Industrial demand from solar, EVs, and AI infrastructure is exploding this quarter, and physical premiums are refusing to fall even when spot price dips. Price is calm. That's what makes this dangerous. If you're stacking silver, watching metals, or sitting this out because silver never moves, this breakdown is for you. If you're watching now, you're ahead of the crowd still staring at spot price, waiting for confirmation. Your job isn't to predict when it breaks. Your job is to understand the pattern, so you recognize it breaking. Let's go. Quick thing before we dive in. Hit subscribe if you want breakdowns on what others ignore. We track flows, not headlines. This isn't hype. It's pattern recognition you'll use again in gold, oil, even bonds. Comment watching if you're tracking silver seriously. I want to know who's in this with me. Now, let's get into what actually shifted. Here's what happened quietly. JPMorgan has accumulated roughly 750 million ounces of physical silver over the last decade plus, not through one purchase, slowly, methodically, while simultaneously dominating futures positioning on COMEX. They've played both sides, holding physical while managing paper price discovery. That's not conspiracy theory, that's market mechanics. When one player controls flow on the derivatives exchange and holds a mountain of physical metal, they set the terms. They decide when volatility gets suppressed, when it gets released. For years, the incentive structure was simple. Keep price range bound, accumulate physical while it's cheap, profit from selling volatility to traders who kept getting chopped. But something changed. COMEX registered silver, the portion available for immediate delivery, has been quietly draining. We're not talking about total warehouse inventory. We're talking about the registered category, the stuff that can actually be delivered against futures contracts. It's tightening. At the same time, physical premiums on coins and bars haven't collapsed during recent price dips. Normally, when spot drops, premiums compress. People sell, supply loosens. Not this time. Premiums are holding. That's stress, not noise. Then you layer in China. They just announced export restrictions on silver as part of broader critical materials controls, not a full ban. Restrictions, the kind that introduce friction, delays, licensing requirements, the kind that quietly choke supply chains without headlines screaming shortage, and demand exploding. Solar panel production needs silver. EV charging infrastructure needs silver. AI data centers need silver for switches, connectors, thermal management. Industrial offtake is rising while supply is getting squeezed geopolitically, and physical inventories are tightening structurally. Think about that. The price didn't move yet, but the valve is closing. Most people won't notice until price already ripped. By then, premiums will be 30–40% over spot. Delivery delays will stretch to months. Retail will panic buy at the top. You're watching now because you don't want to be them. Let me name the mechanism. I call it the inventory valve. Picture a fire hose. Water pressure builds behind a regulator valve. The valve controls flow, keeps pressure manageable. Price is the dial on that valve. Inventory is the water pressure building behind it. As long as there's slack in the system, extra inventory sitting idle, delivery optionality, alternative supply sources, the valve works. Price can be managed. Volatility stays low. But when inventory tightens, when registered ounces drain, when alternative sources get restricted, pressure overwhelms the valve. Control fails, not gradually, suddenly. This isn't unique to silver. You saw it in palladium in 2020 when Russian supply fears hit. Price went from $1,500 to $2,800 in months. You saw it in nickel in 2022 when the London Metal Exchange had to halt trading because physical delivery couldn't meet paper obligations. You see it in natural gas every few winters when storage levels drop below seasonal norms, and suddenly weather forecasts move markets violently. The pattern repeats. The valve works until it doesn't. And right now in silver, every signal suggests we're approaching that threshold. Not predicting when it breaks, showing you the mechanics so you recognize pressure building. Registered COMEX, silver is drifting lower. Physical premiums are refusing to compress. China is restricting exports. Industrial demand is spiking. JPMorgan sits on a mountain of physical while controlling paper positioning. The valve is under stress. Here's what you need to understand. The players who benefit from suppressed volatility, who profit from selling premium, from range-bound accumulation, only maintain that game as long as it serves them. When incentives flip, the game flips. Second mechanism, the liquidity trap. Big players suppress volatility while accumulating. They want calm. They need disinterest. Because disinterest lets them build positions without competition, without retail stampedes, without premiums exploding before they're ready. So they manage price. They absorb selling pressure. They cap rallies. They create a psychological environment where silver becomes the metal that never moves. Traders give up. Retail loses interest. Even stackers get complacent. That's intentional. Volatility suppression is the accumulation and strategy. But once positioning flips, once the big player is fully loaded and no longer benefits from low prices, volatility returns, violently, against anyone who got trained to ignore the asset. It's a trap, not in the sense of conspiracy, in the sense of game theory. If you're the dominant player and you want to accumulate 750 million ounces without pushing price to $50, you have to convince everyone else it's boring. You have to train the market to ignore small moves, to dismiss fundamental tightness, to wait for confirmation that never comes until it's already late. Then, when you're positioned, you let it run. Or you stop suppressing it and let supply, demand fundamentals do the work. Either way, retail gets caught. They ignored it when it was cheap and calm. They chase it when it's expensive and volatile. They're taught to wait for breakouts, for mainstream coverage, for safety signals that only appear after the easy money is gone. You're in this video because you're not waiting for confirmation. You're watching flow. You're watching structure. You're watching what happens before headlines catch up. So here's the question you should be sitting with. Not, will silver go up? The real question. What happens when the biggest player no longer benefits from suppressed prices? Hold that thought. Here's what you need to sit with. For over a decade, JPMorgan's incentive was clear. Suppress volatility, accumulate physical, profit from range-bound conditions. The game made sense. Keep it boring, keep stacking. But when you've accumulated 750 million ounces and inventories are tightening and China's restricting exports and industrial demand is spiking, your incentive structure changes. Now you benefit from higher prices. Now you want volatility. Now every supply shock, every delivery squeeze, every premium spike works for you instead of against you. That's the shift, not a prediction, a change in game theory. When the dominant player flips from accumulation mode to monetization mode, the market structure changes. The valve that kept pressure low gets released. We don't know when. Could be months, could be quarters, but the setup is there. Let me walk through the paths, not predictions, scenarios with signals. In the first scenario, price rises steadily over 12-18 months in a controlled grind higher. Premiums stay elevated but manageable. COMEX registered silver drifts lower slowly. No panic. No delivery failures. Just persistent tightness that grinds price from mid-20s toward 35-40 range. Who benefits? Long-term holders, patient accumulators. Who gets hurt? Shorts, premium sellers, anyone waiting for one more dip. Confirming signals would be steady premium elevation. COT reports showing commercial net long positioning, declining registered ounces without spikes. In the second scenario, we get sudden repricing via delivery stress. A large futures holder demands physical delivery. COMEX struggles to source metal. Price gaps up violently. Think 20% in weeks. Premiums explode to 30-50% over spot. Retail scrambles. Dealers limit orders. Who benefits? Anyone holding physical before the spike. Who gets hurt? Paper traders, late chasers, anyone who thought, I'll buy when it breaks out. Confirming signals would be sharp registered silver drawdowns, rising lease rates, delivery delays reported by dealers, exchange rule changes around delivery terms. In the third scenario, before the real move, price gets slammed one more time in a temporary smash to flush weak hands. Margin calls hit leverage longs. Retail panics. Headlines scream silver crash, but premiums don't collapse. Physical buyers absorb the dip immediately. Who benefits? Buyers with cash and conviction. Who gets hurt? Leveraged traders, panic sellers, anyone without a plan. Confirming signals would be price dropping sharply, but premiums staying firm. Registered silver keeps declining even during price weakness. Large commercial buyers step in aggressively, not telling you which happens, showing you how to read it when it does. Here's what I'm tracking this week, this month. First, COMEX registered silver levels. Normal behavior looks like gradual drift with occasional inflows. Stress behavior shows sharp sustained drawdowns. Inventory shifting from registered to eligible. Reduced delivery optionality. How I interpret this: if registered silver drops below 40 million ounces and stays there, pressure is building. If it drops below 30 million, we're in delivery stress territory. Second, physical premiums over spot. Normal behavior means premiums compress during price dips and expand during rallies. Stress behavior shows premiums staying elevated or rising even when spot drops, indicating physical scarcity decoupling from paper price. How I interpret this: if premiums on standard products stay above 4 to 5 per ounce during price weakness, that's structural tightness, not temporary demand. Third, COT reports and commercial positioning. Normal behavior has commercials net short, managing producer hedges. Stress behavior shows commercials flipping net long aggressively, indicating major players positioning for higher prices. How I interpret this: if large commercials shift from net short to net long and stay there for multiple weeks, incentives have flipped. Fourth, China export policy enforcement. Normal behavior is rhetoric without enforcement, delays without impact. Stress behavior means licensing delays stretch to weeks. Shipment volumes drop measurably. Buyers report actual supply disruptions. How I interpret this: watch trade flow data, not headlines. If Chinese silver exports drop 20% few weeks month over month, friction is real. Fifth, the silver to gold ratio. Normal behavior keeps it range-bound between 75-85. Stress behavior shows the ratio compressing sharply below 70, indicating silver outperforming gold as industrial and monetary demand converges. How I interpret this: compression signals money moving into silver specifically, not just precious metals broadly. It's a late-stage confirmation, not an early warning. Circle this: I'm not telling you what to buy. I'm showing you what to watch and how to interpret changes. Your job is pattern recognition, not prediction. Let's talk about hedges, not portfolio hedges. Mindset hedges. First is liquidity awareness. If you're holding physical, accept you can't sell instantly at spot price during stress. Premiums work both ways. Plan for that. Second is position sizing. If volatility spikes, can you handle a 30% drawdown without panic selling? If not, you're sized wrong. Third is time horizon. This could grind for months before breaking. If you're trading with leverage or short-term expectations, you're playing the wrong game. Fourth is delivery optionality. If you're holding paper, ETFs, futures, understand what happens during delivery stress. Physical and paper can decouple. Fifth, hedges against being wrong. Could this whole thesis collapse? Yes. If industrial demand craters, if China reverses policy, if JPMorgan dumps physical, the setup changes. Watch for those invalidations. Sixth is emotional discipline. The hardest part isn't identifying the pattern. It's not selling during the final shakeout or chasing during the spike. Know your plan before pressure hits. Not advice. Frameworks. Can't know timing. Only structure. If you're a trader, respect volatility. If you're a holder, accept pullbacks. If you're watching from the sidelines, just track the signals until you're convinced. Here's what you need to take from this. Silver didn't move, but the structure underneath shifted. Inventories are tightening. Positioning is flipping. Supply is getting restricted. Demand is spiking. The inventory valve is under pressure. The liquidity trap is set. Most people won't notice until price already ripped, premiums exploded, and delivery delays stretch to months. They'll wait for confirmation that only comes after the easy money is gone. You're not most people. If you're watching flows instead of headlines, if you're tracking registered silver instead of spot price, if you're interpreting premium behavior instead of waiting for breakouts, you're already in the group that sees it early. You're ahead. Not because you predicted the move, because you understood the pattern, and that's the difference.
Wealth transfers don't announce themselves with headlines and CNBC breaking news alerts. They whisper through premiums staying firm during dips, through inventory classifications shifting, through policy changes that sound boring until they're not. You heard the whisper. Now you watch the signals. Comment below. What signal do you watch first? Registered silver, premiums, COT positioning, or something else? I want to know what you're tracking. If you found value here, hit subscribe. We do this every week. Patterns, signals, mechanisms you'll use across markets. And remember, your job isn't to know when it breaks. Your job is to recognize it breaking. Stay disciplined. Watch the valve. Don't get trapped. Links to COMEX data and COT reports in the description. I'll see you in the next one.